Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also, note that this presentation contains hypothetical computer-simulated trades and/or results. They're believed to be as accurately represented as possible. Keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC. And my team and myself are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of high probability options trading. Now, high probability options trading, also known as income trading, is where we utilize time to make money rather than solely depending on price movement to make money in the marketplace, meaning we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean we have a much higher probability of winning than we would if we were purely directional. And the strategy we're going to be talking about today is something called the SS Bearish Butterfly, also known as the bear trade. Now, this is very similar to the trade that we did on the last episode. The last episode was the actual bearish butterfly. This is a simplified variation of that strategy, and it appears to be fairly similar, but in some ways it's actually quite different as well. Now, these trades, you'll notice that in the last couple of months we've been kind of transitioning, or you're seeing some trading strategies here in the winning trade that you may not have seen in the last 8 or 10 months. And part of the reason for that is the market conditions have changed. It was not too long ago, or ever since the 2020 bottom after this little COVID thing started, you could pretty much buy any stock. And since the whole market's going up, a rising tide floats all boats, as they say. It brings a majority of the stock market with it. So you could literally take a dartboard, throw a dart at the dartboard, pick a stock, and make money. That is going to be changing. See, we're transitioning into this more sideways volatile market, meaning you can't simply buy things and expect them to go up and make money anymore. And this type of market, if it continues, and I believe it will, it warrants being traded differently. And this bearish butterfly that we talked about last week, the super simple bearish butterfly, or the bear trade, which we're talking about this week, they both take advantages of that type of market, as does our X4 version 22, which you probably haven't seen in a while because the bullish market conditions are not that great for that particular strategy. These sideways markets are very favorable to that type of strategy. So you're going to see things like that coming into play here. It's also maybe a prompt to think about the way you trade. If you're having trouble now, it may be because the market has shifted. And whatever trading style you were doing doesn't really fit the marketplace anymore. And that's where these time strategies really come in, because we're not dependent on any particular direction. Yes, we do have some strategies that are more bullish. We have some strategies that are more neutral, and some strategies that are more bearish. We do have that. But the great part about these strategies is they often do well in any of those environments. Although we do have the same type of thing where some strategies will do better in particular environments than other strategies. And again, this bear trade is one of those strategies that is expected to do well in the near future. So the bear trade is something that we teach in our Go membership. With our Go membership, we have something called a FIT program. And in our FIT program, we have the guidelines outlined for the bear trade. So let me tell you a little bit about the bear trade. We do this on the Russell 2000. The trading strategy takes advantage of a variety of market conditions, such as overextended uptrending markets, volatile and very volatile sideways markets, which is what we're going into now, as well as volatile downtrending markets, which may happen. I'm not expecting that, but we could end up breaking down here on the market. My thoughts are we're actually going to go sideways. If you look at our market outlook, we outline how we come to that conclusion. And if we have a smooth downtrending market, this bear trade tends to also do well. The strategy itself requires a minimum of $5,000 capital, or planned capital as we call it. The profit target on the strategy is going to be 30%, so it's one of those high profit target strategies, and that's going to be a $1,500 gain if we do that on our $5,000 trade size. And our exit loss trigger is going to be 30% also which is going to be $1,500 on a $5,000 trade size. The example today we're going to do is actually going to be a $5,000 trade size. So this is one of those examples where we show with a small amount of capital. It's better for beginners, right? So let's take a look at the bear strategy. So for those of you who are new to us, this is something called an analytical software. It's called OptionNet Explorer. If you look at the graph or the chart here, this shows us the risk profile of our position. So unlike a price chart, the asset price on this goes along the bottom, and along the right side here is our profit and loss. So you'll see two lines on this graph, and one of them looks like a triangle, or it's very sharp edged here and it's in blue. That would be called our expiration line. Our expiration line represents the value of this position, or the profit and loss in this position, at any price point as of expiration. So we're going to be dealing with options. Options have a certain amount of time they're valid for, and then when they run out of time, they expire and they settle the options. If the asset price in this example here is $22.30 at expiration, we would make $4,500. If it was down here at, let's say, $2,100 at expiration, we would be down about $400. It's a very good defined risk trade. Right now, we currently have, I guess this actual margin, this tells us our actual margin here is we actually have $419 in the trade. Now, you'll notice I said this was a $5,000 planned capital trade. Depending on how this goes in the implied volatility skew curve environment, we could get up to $5,000 in the trade. The reality is, in today's implied volatility skew curve environment, it's very unlikely we're going to get much more than $1,500 in the trade, maybe at most, meaning that our returns are actually much, much higher. This is actually a much better trading environment than we've had historically. And I actually got a question from one of our viewers asking, well, are we going to use butterflies in this challenging trading environment? My first thought is this is actually one of the best trading environments for butterfly type strategies that we've ever had. Basically, we're getting paid a lot to have our positions on. We can make a lot of money with very little risk, and that's really great. Now, again, this may be challenging for certain particular types of strategies, including some butterfly strategies that are very positive delta, for example. When we get into a sideways market, you kind of have it helps to have your timing right in a bullish strategy. Here, I would call this a more neutral to bearish strategy. You know, if we're in a sideways market, these tend to do really, really well, and we're getting paid well. So it's kind of a win-win. I really like it. Anyway, since we're trading with a smaller amount of capital, some people ask, well, why don't you, since the butterflies are so cheap? And by that, I mean, we're paying $4.19 to get into this trade. In, say, 2015, if we were trying to get into the same trade, we'd be paying probably $12, or maybe a third of the cost that we used to be. Why don't I just trade bigger? Well, I also have my loss considerations to consider. If I trade bigger, I have to account for or allow a bigger loss or drawdown in the position. So anyway, this positioning here is called a butterfly. This curved line is what we call a T+0 line. That tells us the value of our position at any price point in the Russell as of today. This is a projected value. The expiration line is a definite value at a definite time. This here is going to be projected. This T+0 line isn't always right, but it gives us an idea of what the position should do. As you can see right now, we're what we call negative delta. So delta is how much your position loses or wins with $1 of price movement in the asset. So we're at a delta of minus 0.84, which is telling us if Russell goes up $1, then according to delta, we should lose 84 cents because if it goes up $1. If it goes down $1, we should gain 84 cents because we have a negative number here. This changes throughout the trade. It's a number sometimes we use to make adjustments on the trades. Not on this particular strategy, but on some of the other ones. So the way this strategy works is we're going to enter a butterfly, and that's what this position looks like. Over here we have our matrix. Our matrix is telling us these are our options chains, or the cycles of expirations of our options. These are the strike prices of our options up the left side here. We have our calls on the tops, our puts on the bottom. I'm doing this in put options. Here I'm selling to 22.30 options. I'm buying 122.80. I'm buying 121.80. This is a 50-point wing butterfly with the short strikes at 22.30. This is what it looks like on the graph. As far as date, this represents Friday, the 26th of November at 12:30 p.m. Eastern Time. The current asset price is $22.48. The change for the day was 82 down, which is actually a huge down day. And this is where we stand. So the reason I'm at 12:30, this trade, by the way, is like our other trades. We have a singular checkpoint time of the day. We generally enter and check the trade at 3:30 p.m. Eastern. This particular day was a half trading day, so we're looking at 12:30 Eastern, which is a half an hour before close. We're going to come in here. This bear trade starts 56 days to expiration. This is non-subjective, so we're not looking at charting or anything like that, or we're not using charting to determine our entry, although you could. We do have many traders who trade the bear strategy subjectively because it is a bearish strategy. They want to, it's more favorable, obviously, to enter it if the market's likely to come down. So we do have traders who do that, but the way we demonstrate them and the way we do them in the Go membership on Options Trading for Income, we're being non-subjective, meaning we're not looking at these numbers. If you do want to look at the price chart, this is pretty much what happened here. I don't know that I really favor enter. If I was being subjective, that I would favor entering this particular strategy at this time because we just had a big down move and the market's likely to bounce, right? But again, we're doing this non-subjectively, and the general market environment is sideways anyway, so it's probably not going to be an issue. So here, if we take a look at this, what we do with this strategy is we scale in, what we call scale in to the upside, and we scale out or exit to the downside. So here, I'm positioned bearishly. In other words, if I get a down move, it's not going to hurt me. The asset price can really come all the way down to 2,100 or lower, not really a problem. With an up move, the position draws down. This trade scales in with an up move, so it gets larger, and we're going to show that to you as we move on here. And then, of course, we can scale back out if we come down. If the market comes down too much, we just exit our profit. So here we are on this day, Friday the 26th. Get the big down move. It's our entry date. We don't care this down move necessarily, but this is our entry date, so we enter. I go to Monday here. I'm just going to fix my time frame to 15:30 because that's our checkpoint time. So in one day, even though we got more or less an up move in the marketplace, we got a nice, what we call implied volatility shift, and our position is up $111. If we move forward here, market does pull down a bit. This is actually a bad time frame, but if you take a look here, let's go 5 minutes. This position here is, we got our pullback. We're up about $71. Everything's doing fine here, no problem. Ideally, with this strategy, we would like some time to go by before the market pulls back. The concept of the strategy is it takes advantage of the market going up, getting scaled in, and then coming back down. But that didn't happen here. We just went down. Go to our next day here. Now we start getting a bounce in the marketplace. Actually, it's just kind of chopping back and forth. You can see how this likes to chop. See, we're chopping back and forth in a range here. Now we're up $86. And then finally here on the 8th, let's take a look at what happened. So we entered with our short strikes at 22.30. With a bear trade, we scale into this when the price goes up a certain amount. So these are all predetermined price points that are within the strategy. But our add point here is going to be at 22.70. We're going to add to the position. And then when the asset price hits 22.90, we're going to add to the position again. If the asset price keeps going up, we're going to start rolling the position. So here we're up over 22.70. We're at 22.75. So we're going to come in and we're going to add in our second third of the position. And this is what we look like here. You can see now instead of like $400 or $500, we now have about $1,000 capital in it. And this is how the capital gets increased in the trade. Then if the market continued to go up, we put another 30 and we probably have close to 1,500 in it. If we have to do roll sequences, sometimes that increases capital in the position. Typically to the downside, we decrease capital in the position, but to the upside, we're going to increase. So this is what we look like here. We're up at 22.75. We're up $82 in profit. And let's just show you how the price moves here. Market pulls back. And this is the scenario we want. We want to get scaled in. We want the market to pull back and then get us into our range. If that happens and the timing's good on it, a lot of times you'll be up $1,500 or so. But as we saw with this particular trade, the timing wasn't that great. We had a down move first, then an up move, and now we're having a down move. So now what we would like the market to do is basically stay ranged in here, maybe even a little bit higher than we are now. I don't want to get too far down, because if I get too far down, I have to, what we do is we scale down out of the position. So let's go to the 14th here. This is still okay. Good. So here on the 16th of December, we end up being outside of our tent here, and we end up being fairly positive delta. What we want to do here, if that becomes an issue, is we want to scale back out of the upper side. We don't want to take on too much downside risk. So what we're going to do is we're going to come in, we're going to sell out this 2250 butterfly. So let's sell that out. And this is our new position. We're still positive delta, but we're relatively neutral in the delta category here. And you can see our risk is down to only $279. That's the maximum we could lose on this, and we're up $403. So we're in a really good situation here. So let's move this forward. Ideally, we want this just kind of to range in this area here. And we're pulling back a little bit. This is an area where we do have a technical exit on this, where if you have too much trouble to the downside at this point, we're just going to exit. We've made the money. We're just going to exit out. This isn't what I would call too much trouble. It's kind of borderline, though. If this was much more positive delta than this, say too positive delta on a position this size, I just let it go for a profit. If we go here, 358. Now we're at 448, so we're doing well. 518, 493, 548. So now on our planned capital, remember we have $5,000 planned capital. We're up about 10%. We'd like to be at 1,500, but the market movement isn't really doing what we would like it to do. But the trade's still going pretty well. What I do like about this is the maximum amount of risk we had in this was about $1,000. And if you take a look at that, that's like a 50% gain on the strategy. So it's really fantastic. If I go here to the following day, I'm just going to uncheck ignore trades because there's going to be a trade in a minute. I'll tell you why. For the 30th. And our add point, remember, is at 2270. So if we see 2270, we would add in this other third. Come in here Friday. This is what the position looks like Friday. Now, the bearish butterfly, if this was a bearish butterfly, we would continue to trade this. We would trade this in, and we will trade a bearish butterfly right into expiration. The bear trade, again, being a more simplistic variation of the strategy, there are some substantial differences in the way we treat this. And one of those differences is we're exiting this when we're 21 days to expiration, regardless of what our profit and loss is. We're going to exit, and we're going to exit this at a profit of $673. So if you take a look at percentage-wise of what we actually had in it, that's about 67% of our actual capital. Fantastic trade. It's a fairly simple trade. We put the trade on. We had to add in a third, which is adding another butterfly at one point in the trade. We pulled that back off again in the trade, and then we have the trade exit, and we went from 56 days to 21 days. That's going to be what? That's 35 days. So 67% on actual capital in 35 days, and that is the bear trade, this episode's winning trade. If you like what you see, I encourage you to come over to thewinningtrade.com. That's thewinningtrade.com, and discover how you too can follow along with this and many other great strategies real time in our options trading for income webinars that we have every Monday morning. Also, where you can learn about upcoming winning trade presentations, explore past winning trades, and perhaps best of all, you can find out about our free trading performance podcast, where you can learn to skyrocket your results in trading regardless of the type of trading you do. Thank you for joining me. If you have any questions, comments, or any topics you'd like covered on the next winning trade, please post that in the comments below, and I'll make sure I answer those questions for you personally. Thank you for joining me. I look forward to seeing you on the next winning trade.